Imagine a massive bucket of money. We are talking $1.5 trillion.
Wow.
Yeah. Now imagine dragging that bucket into the street and just setting it on fire, right in the middle of the biggest, most aggressive tech boom in human history. That is exactly what has happened to the iShares expanded tech software sector ETF this year.
I mean, it sounds impossible when you say it out loud like that,
Yeah.
right? Especially considering the broader market.
Yeah.
But, the data does not lie. We're looking at a historic destruction of value here.
And that is exactly why you and I are here today, Wednesday, March 25th, 2026. We are doing a complete deep dive into this specific exchange-traded fund known by its ticker symbol IGV.
Right.
We have a massive stack of sources on the table to figure out how a tech fund bleeds this heavily in an era that is completely dominated by tech. We're pulling from official BlackRock and iShares fund fact sheets, technical market data from bar chart and StockScan.
Some really interesting comparative analytics from Portfolios Lab, too.
Exactly. And a truly eye-opening macroeconomic report from UBP that details how artificial intelligence is, well, fundamentally rewriting the laws of software.
It is a phenomenal stack of data. We're going to unpack the current valuation, the shifting business landscape beneath these companies,
Yeah.
how IGV stacks up against a rival ETF, and finally, what the technical algorithms are screaming about its future.
Yeah, it's a lot to cover.
It is. And before we get into the weeds, I do need to state clearly, this analysis is for entertainment purposes only. Consult a professional for your specific case.
Always. Because, your specific case might involve wondering why your software portfolio is cratering right now.
Yeah, definitely.
So let's look at the current stats. As of today, IGV stock price is sitting at $80.40. That reflects a brutal year-to-date drop of nearly 24%.
Which is huge.
Right. But here's the part that genuinely makes my head spin. When you look at the price to earnings, or PE ratio, our sources show it hovering anywhere from like 34 to 45. iShares puts it at 45.1, while stock analysis calculates it around 34.83, depending on trailing versus forward metrics.
Yeah, there's a bit of a spread there.
Either way, you are paying an enormous premium. Why would anyone pay 45 times earnings for a sector that just incinerated $1.5 trillion in market value?
Well, that is the core paradox of IGV right now. I mean, a high PE ratio usually implies that investors expect explosive, gravity-defying growth in the future.
Right, you're paying for tomorrow.
Exactly. You pay a premium today because you believe the earnings will double or triple tomorrow. But the market is slowly waking up to the fact that the expected growth for traditional software might actually be a mirage.
Okay, so to really understand the valuation, we actually ran the numbers on a 10-year discounted cash flow analysis, right? A DCF model.
We did, because you can't just look at PE. You have to look at intrinsic value.
Right.
So for this DCF, we used an aggregated proxy for the fund. We established a free cash flow base of roughly $3.50 per share to represent the underlying portfolio's cash generation.
$3.50, okay. And what kind of growth are we expecting on that?
We modeled a 10-year DCF using a 9% growth expectation.
9%. That seems, well, is that optimistic given the AI threat?
It's a fairly standard historical expectation for software, but maybe generous now. So we grow that cash flow by 9% for 10 years. Then we have to calculate the terminal value, right? The value of the fund forever after year 10.
Right, the terminal value. How did we calculate that?
We used a very conservative 2.5% terminal growth rate. And to bring all that future money back to today's dollars, we applied a 10% discount rate.
A 10% discount rate. Got it. So when you run all that math, the 9% growth, the 2.5% terminal, discounting it back at 10%, what is the final calculated intrinsic value we get for IGV?
The intrinsic value comes out to roughly $73.62 per share.
Wait, $73.62? But the current stock price is $80.40.
Precisely. So even after this massive 24% year-to-date drop, the ETF is still trading at a premium to its intrinsic value. It is fundamentally overvalued based on its cash flows.
That is wild. And to understand why those cash flows are so threatened, we have to look at the UBP report's core thesis.
The structural turning point.
Yes. For the last decade, software as a service, or SaaS, was the undisputed golden child of Wall Street. It offered predictable, recurring revenue.
The holy grail for investors.
Exactly. But that legacy SaaS model is currently being gutted by artificial intelligence. Large language models from companies like OpenAI and Anthropic are evolving into a central intelligence layer within enterprise systems.
Right.
And by doing that, they are effectively replacing the functionality of traditional software.
Okay, let's unpack this. because the business model of traditional software is highly specific, and I think people misunderstand how vulnerable it actually is.
Yeah, the per seat model. Right. Think of traditional saws like a toll booth on a highway. You, as a company, pay a monthly fee, a toll, for every single employee who needs to drive through that booth to use the software. You pay per seat.
Which works great when you have a lot of employees.
Exactly. But AI isn't just a faster, better toll booth. It is a helicopter. It completely bypasses the need for the human employee to take that road in the first place. You pay for the flight, the AI usage, and suddenly you have dozens of old software toll booths sitting completely empty.
What's fascinating here is exactly that misalignment in how these companies make money. The fundamental mechanism of per-seat pricing is breaking down.
Right.
If autonomous AI agents are doing the prospecting, the coding, or the customer service, the human employees don't exist to occupy those digital seats. So who is the software company selling licenses to?
Right, like if I have a sales team of 50 people using 50 CRM licenses, and AI allows me to shrink that team to 10 people, I'm calling my software vendor and canceling 40 subscriptions.
Exactly.
That isn't just a lost sale, that is active demand destruction.
And that destruction is happening at an unprecedented speed. I mean, OpenAI and Anthropic have already reached $25 billion and $20 billion in annualized revenue.
That's just staggering.
It is. They scaled faster than any leading SaaS company in history.
Mm.
They are directly siphoning the IT budgets that used to be earmarked for traditional software vendors.
Which brings us back to your earlier point about the high valuation in the DCF.
Right.
In finance, the reaction to this threat is called valuation multiple compression.
Okay, break that down for us. What does multiple compression actually look like on the ground?
Well, it means the fundamental business of these legacy software companies hasn't collapsed to zero overnight. They are still collecting tolls today.
Sure.
But investors are drastically repricing their future. They're looking at the EV to sales multiple, which is enterprise value divided by annual sales. It's a key metric for software because it measures what the whole company is worth relative to the revenue it brings in.
Historically, SaaS companies commanded an average multiple of 9.6 times their sales. Today, that multiple has plummeted to around 5.8 times.
Oh, wow. So the market is essentially saying, sure, you have $1 million in revenue today, but your business model is expiring, so I'm no longer willing to pay $10 million to own your company. I'll only pay 5.
That is the exact mechanism. The predictable, recurring revenue that Wall Street loved is no longer predictable.
Which means if you own IGV, you are holding a bag of expiring toll booths, or at least that is what you would assume. But if we open up the hood of this ETF to see what you were actually buying, it gets really confusing.
It does.
Because I was looking at the top holdings breakdown from this 118 stock portfolio, and the top weights are undisputed heavy hitters.
It is a very concentrated bet at the top.
Highly concentrated. You've got Palantir making up 9.24% of the fund, Microsoft is at 8.33%, Oracle is 8.16%, Salesforce is 7.18%, and Palo Alto Networks sits at 5.32%.
Yeah, some of the biggest names in tech.
So I have to push back on this whole doom and gloom narrative. If heavyweights like Microsoft and Palantir are literally the ones building the helicopters, if they are leading the AI revolution, why on earth is this ETF down 24%? Shouldn't these massive giants be acting like a rising tide, lifting all boats?
If we connect this to the bigger picture, we have to look at the severe dichotomy inside IGV.
Yeah.
You're absolutely right about the top holdings.
Right.
AI infrastructure companies, major cloud databases like Oracle and Microsoft, and cybersecurity names like Palo Alto and CrowdStrike are actually doing quite well. They're the architects of the new AI reality.
Yeah.
But you mentioned earlier that this ETF holds 118 stocks.
The long tail of the portfolio.
Right. Those giants at the top are anchored down by the sheer volume of single-function legacy software providers that make up the vast majority of the fund's holdings.
Ah, I see.
Think about the chief information officer at a Fortune 500 company. Their IT budget is relatively fixed. If they suddenly need to find $10 million to integrate Microsoft's new enterprise AI tools, they don't just magically print new money.
They have to cut from somewhere else.
Exactly. They go through their department and ruthlessly cancel a dozen smaller single-function SaaS subscriptions, project management tools, basic HR software, secondary communication apps to pay for it.
So the giants at the top of the ETF are thriving specifically by cannibalizing the revenue of the smaller companies at the bottom of the ETF.
Yes, and IGV holds both the cannibals and their lunch.
That is a phenomenal way to put it. The mathematical reality is that the AI winners in the fund simply cannot generate enough upward momentum to offset the dozens of legacy losers dragging the sector average down.
Exactly.
Which immediately makes me wonder, if IGV's hyper-focus on software makes it a sitting duck for this kind of disruption, is there a way to invest in the broader tech boom without taking on all this legacy software baggage?
That is where comparative analytics become essential. We need to isolate the software-specific risk from general technology risk.
Let's do that. Let's look at the portfolio slab data comparing IGV against a rival ETF, XLK. For those listening, XLK is the State Street Technology Select Sector SPDR ETF. It tracks a much broader technology index.
And the performance clash between the two is stark.
It really is. While IGV is down nearly 24% year-to-date, XLK is only down about 4.9%. And if you zoom out to a 10-year annualized period, XLK absolutely dominates. It boasts a 21.47% annualized return compared to IGV's 15.24%.
The raw returns tell part of the story, but institutional investors focus just as heavily on the risk taken to achieve those returns. This is where metrics like the Sharpe ratio and the Sortino ratio come into play, and the divergence here is critical.
I know these ratios can get a bit dense. Can we ELI 5 this? Like, explain it like I'm 5?
Absolutely. The Sharpe ratio measures your return relative to all volatility. Basically asks, for every bump in the road you endure, how much money are you making?
Okay.
A higher number means you're being well compensated for the turbulence. XLK sits at a very healthy 0.98. IGV, however, is completely underwater at a negative 0.59.
Meaning IGV investors are experiencing all of the turbulence with none of the financial reward.
Exactly. And the Sortino ratio takes it a step further. While the Sharpe ratio penalizes an asset for all volatility, even if the stock shoots up really fast, the Sortino ratio only penalizes the asset for downside drops.
So it isolates the bad risk.
Right. And again, XLK vastly outperforms IGV here.
But wait, looking at the historical data, XLK has actually had a steeper crash in its past.
Yeah.
The data shows XLK suffered a historical maximum drawdown, like the largest peak-to-trough drop in its history of negative 82.05%.
That's true.
IGV's worst historical drawdown was only negative 63.45%. How does XLK have a better risk profile today if it historically crashed harder?
Because XLK historically recovers much stronger. It absorbs macroeconomic shocks and bounces back to new highs, whereas IGV struggles to regain its footing after a drop.
Yeah.
And beyond the performance, you have to factor in the literal cost of holding the asset.
The expense ratios. This part always gets me.
Yeah, it's a big difference.
IGV has a relatively high expense ratio between 0.39% and 0.46%, depending on the exact fact sheet you reference. And for that premium fee, it pays you virtually zero dividends.
Right.
Meanwhile, XLK is significantly cheaper to own. It has a tiny 0.08% expense ratio, and it actually yields a low 0.56% dividend. You are literally being paid to hold a broader, better performing asset. Why the massive difference in resilience?
It really comes down to diversification of business models. XLK's broader tech mandate includes hardware, semiconductors, and broad IT services. It provides a structural buffer.
Ah, okay. Hardware and chips are the literal picks and shovels of the AI gold rush. XLK holds the companies building the physical infrastructure.
Exactly.
IGV is just holding the software maps, and as we've established, some of those maps lead straight off a cliff.
Precisely.
Yeah.
XLK protects the investor against the acute, hyper-specific disruption that is ravaging the software-only world right now.
So we have terrible fundamental headwinds with AI replacing software seats. We have competitor comparisons that make IGV look expensive and sluggish. If the reality on the ground is this grim, what are the traders and the algorithmic forecasts signaling? Are they seeing something we aren't?
Well, technical analysis is useful here because it strips away the business models entirely and just gives us a snapshot of market psychology and momentum.
And according to the bar chart and stock scan data, that psychology is overwhelmingly bearish.
Extremely bearish.
Let's look at the moving averages. The current price of $80.40 is sitting miles below the 200-day moving average, which is up at $104.05.
That's a huge gap.
Yeah. When we look at the suite of moving average indicators across different time frames, the 20-day, the 50-day, the 100-day, 10 out of 10 of them signal a strong sell. 0 signal buy. It is a complete sea of red.
A moving average breakdown of that magnitude indicates a sustained, heavy downward trend. The market is aggressively repricing this asset downward day after day, and there is no technical floor forming yet. The momentum is entirely negative.
But here's where it gets really interesting. When you dive into the algorithmic price forecasts, there is this wild, almost comical contradiction in the data.
Oh yeah, this part is fascinating.
Short-term analyst price targets inexplicably predict a massive 224% upside in the next 30 days. They give it an average short-term target of around $260.
Right.
Yet, when you look at the long-time algorithmic forecast for the year 2030, the computers bizarrely crash the price target down to anywhere between $56 and $6. How on earth can the data predict a 200% rally this month and a near-total wipeout by the end of the decade?
It looks like a glitch, but it actually perfectly illustrates the two different ways algorithms interpret market panic. The algorithms generating those short-term targets are completely ignoring the fundamentals of the AI disruption. They're purely momentum-based, looking for mean reversion.
Oh, they just look at a chart, see a steep drop, and assume a rubber band has to snap back.
Exactly. For instance, the data shows a technical oscillator called the STOCH value, the stochastic oscillator, sitting at 15.57.
Okay, what does that mean?
Well, this is a scale from 0 to 100. Anything below 20 is considered drastically oversold. It triggers a mechanical buy signal because the price has dropped so fast and so hard that short-term day traders might step in to buy the dip, causing a temporary violent bounce upward.
The rubber band is stretched to its absolute breaking point.
Yes, but a short-term bounce in an oversold asset does not mean the underlying business model is fixed. A dead cat will bounce if you drop it from high enough.
That's a grim image, but accurate.
The catastrophic 2030 forecasts, the ones predicting a drop to $6, are generated by entirely different algorithms. Those are long-term fundamental models. They are projecting future cash flows, and they are mathematically pricing in the terminal threat of AI to legacy software revenues.
So the computers are essentially giving two separate pieces of advice. The momentum bot is saying, trade it tomorrow for a quick bounce. And the fundamental bot is saying, but for heaven's sake, do not own this in 5 years because the company will not exist.
That is a highly accurate translation of the data, which brings us to a final, synthesized verdict based on all the sources we've examined today and that DCF intrinsic value we calculated earlier.
Right, the $73 intrinsic value.
Exactly. If a listener is looking for a clear buy, hold, or sell signal on IGV right now, the data heavily leans toward a sell.
Based on that premium.
Yes, based on the current stock price's premium to the calculated intrinsic value. Even at $80, you are overpaying. Or at best, it's a very cautious alignment. If you are already trapped in a losing position and you are gambling on that short-term oversold bounce to minimize your exit losses.
The evidence is just overwhelmingly stacked against it.
It really is. The technical indicators are predominantly bearish across almost all moving averages. The broader macro environment, as detailed by the UBP report, proves legacy software is actively becoming commoditized by AI.
Yeah.
And fundamentally, you're paying a premium expense ratio for an ETF that is significantly underperforming alternative, broader tech ETFs like XLK, which are actually equipped to handle the AI transition.
It really is the ultimate real-time case study of a sector caught directly in the crosshairs of technological disruption. We are watching the transition from software as a service to AI as a service reshape the market right in front of us.
It is an incredibly painful process for the old guard who built their empires on per-seat subscriptions.
It is, and this raises an important question about the very definition of the sector moving forward. I want to leave you, our listener, with a mind-bending thought inspired by that UBP macro report.
The operational efficiency predictions.
Yes, they predict that AI could automate routine enterprise tasks like basic coding, data entry, and customer service so effectively that it cuts global operating expenses by a full 10%. They project that this efficiency will save the world $2 trillion by 2030.
$2 trillion. It's almost hard to fathom.
Think about the implications of that. If AI eventually writes its own code, deploys its own updates, and runs its own infrastructure, will the software companies of the future even look like tech companies?
Probably not.
Right. Or will they transition into massive automated digital staffing agencies, leasing out digital workers by the hour instead of software by the seat? And if that happens, what exactly is an ETF like IGV going to be tracking in 10 years? Will it just be a graveyard of empty toll booths?
It is a profound structural shift. The companies that survive this decade will be the ones that adapt to being intelligence providers, not just software vendors.
So what does this all mean? It means the future is coming fast, and you're now equipped to understand it. Keep an eye on those heavyweights inside IGV, but beware the massive anchor of legacy tech dragging them down. Thank you for joining us on this deep dive. We'll catch you on the next one.